This episode is brought to you by Suzy, a cutting-edge market research software platform that empowers some of the biggest companies in the world, like Citibank and Procter & Gamble. To find out more about how Suzy can help you stay competitive, go to tearsheet.co/Suzy. Welcome to the Tearsheet podcast, where we explore financial services together with an eye on technology, innovation, emerging models, and changing expectations. I'm Tearsheet Editor-in-Chief, Zach Miller. As the global blockchain leader at EY, Paul Brody is responsible for driving EY's initiatives and investments in blockchain technology across consulting, audit, and tax business lines. He's also currently the chairman of the Enterprise Ethereum Alliance. He's held a number of leadership positions in the areas of IoT, supply chain and operations, and business strategy, working with client organizations such as HP, Samsung, LG, Apple, and the list goes on. Paul, welcome to the Tearsheet podcast.
Thanks for having me.
So I'm curious in this role how you've seen, given your seat, EY's blockchain strategy evolve as the technology behind it has evolved.
So I'm just actually coming up on my 10th anniversary at EY. I'll be there in a few minutes. I wish they had not announced my original joining of EY on April 1st, 2015. It was not an April Fool's joke. Yeah, I have to contend with that every year on my work anniversary. Like, so glad you're here. It's April Fool's Day, by the way. So, in some ways, one of the things I'm most proud of is how little our strategy has evolved. For a decade, we have been really very specific at EY, which is, first and foremost, we really believe in the value proposition of public blockchains, right? Secondly, we have been, from day one, our message has been quite consistent. Bitcoin is the asset, ETH is the platform. And then thirdly, our message has been, for enterprises, for institutional investors, enterprises, like really serious players in this business, to adopt at scale blockchain technology, we need privacy. And so we've been working over the last 10 years, we've been working substantially from an engineering perspective on building privacy. What I'm proud of is that our viewpoint, our strategic view hasn't changed, but the technology and what the technology makes possible has changed enormously, and the views of the rest of the market have also changed so dramatically over that time period.
So if I can double click on that, why the public blockchain with the privacy nuance versus going just directly to a private blockchain?
So this is one of the funniest things that I've ever seen, right? A lot of people don't realize, and you see this all the time, especially in large enterprises and financial institutions, they don't realize private blockchains have no privacy. Inside, if you think of a private blockchain as like a four-wall garden, right? It is true that people outside cannot see what's going on inside. But inside, there's also no privacy. So if you have two big companies, Company A and Company B in the same industry, they still can't really disclose any sensitive information on a private blockchain because their competitor is going to seal that. So private blockchains have no privacy. They also kind of defeat the point of blockchains. If you're going to have a centrally run decentralized ledger, it's just going to be much simpler to build a classical enterprise server. So right. If you really sit and think about it critically and you understand the technology, you very quickly come to the conclusion that private blockchains don't make sense. The only value proposition that makes sense is a public blockchain.
And so this privacy layer on a public blockchain would enable, say, large financial institutions to open it up to their trading partners, to their clients, but with the level of lack of disclosure or lack of public access that they need, basically, for everybody to feel safe on that network?
So the privacy infrastructure on a public chain works, it preserves, and this is why it's technically very difficult, it preserves a lot of the things that we want about a blockchain. It preserves the decentralization, it preserves the prohibition on double spend and the reconciliation of assets that they move, and it preserves the verifiability of all transactions on chain, right? So if an auditor or regulator came to you and said, I want to know what you did in this privacy layer, you can not only show that information, you can prove that the information you are giving them is truthful. However, what you are doing is, instead of making publicly visible the details of your transaction. You are just publishing mathematical proof of the validity of your transaction. And that's just hugely important if you are a large institution and you want to have a proprietary trading strategy. You can't do that on the public chain right now. If you're an enterprise and you think about enterprises, what they're buying, how much they're paying for it, where it's going, that's really sensitive business information. So if we want enterprises to use public chains, and there's lots of value in doing so, then they need some privacy technology in which to do that.
Got it. And one of the things we've been tracking this, since its earliest days within the financial services industry. We've had recently, the president of MasterCard on the show talking about some of the current use cases that they found for public blockchain. What are you seeing as sort of the most emerging or most interesting use cases within financial services, given your perspective?
So I will just start. Let me just start back up at the big picture and say, at the really global level, I believe all B2B transactions are suitable for blockchains. Every transaction comes down to, I've got money, you've got stuff, and we're going to exchange my money for your stuff under the terms of an agreement. So that means tokenizing the money, tokenizing the stuff, and writing the business logic of the agreement as a smart contract. That means all B2B transactions are ultimately doable on a public chain. Now, inside of financial services, we're in this really interesting phase right now. So one of the main things that you can do in a financial services environment without privacy is you can have the exchange of fungible tokens, right? Money tokens, bond tokens, asset tokens. And if it's going through an exchange or something else, you have the benefit of some level of privacy because your transaction stream is being merged with a bunch of others. So right now we're in the early stages of a really, really big real world asset boom. Started with treasuries, started with dollar tokens for payments. So we're having a real world asset boom. We're having a payments boom. What the big challenge that's going to emerge next, and this is something I call like the new blockchain trilemma, is what is it in a world where you can tokenize any real world asset, right? And blockchain is so cool, like syndicated loans, private equity components,
mortgages,
pre-IPO
right.
share, the universe of things that you can tokenize is infinite. And the problem is that's quickly emerging when I talk to clients all around the world is, okay, we can tokenize anything. What do people want to buy? And we already have some very unfortunate case examples of clients who have tokenized assets. Like I had a client that tokenized real estate in the country, and turns out nobody wants this particular kind of tokenized real estate. So we are in because of the election, we're in an exciting new period of we think we'll be able to do a lot more stuff in the future, right? Particularly here in the US. But we are also now confronted with infinite possibility. People are suddenly like, whoa, so what is it that people actually are going to want to buy with their with their tokenized money? And that's going to be the big new challenge, I think.
Interesting. So beyond identifying where core demand is for some of these assets, what do you think are some of the biggest hurdles, I guess, at the enterprise level for adopting blockchain technologies?
So I think about technology adoption at the enterprise level for tokenization and smart contracts a little bit in a similar way that I observed the same thing happening when I was younger in the space of e-commerce. Right. So in the early days of e-commerce, and I was a wet behind the ears McKinsey consultant. I got to see a lot of the inside of this kind of experience. There were a lot of challenges, right? First of all, people kept saying, okay, for example, I don't think people are going to buy X, whatever it is, online. Well, it turns out whatever it was, they were willing to buy it online, right? Groceries, shoes, doesn't matter. Whatever people said that they were not willing to buy online, they were willing to buy online when they figured out the right marketing strategy. Secondly, though, even when people had home computers, they had high-speed internet, it turns out every time you solve one problem, you run smack into another constraint. For example, we had online catalogs in the late 90s and the early 2000s, but they had no pictures because a store manager at a grocery store doesn't need to know what an avocado looks like, right? They just click the buy button or the replenish button. We're going to see the same series. Like right now, we have millions of people with wallets. right? But maybe they don't have ETH or they don't know how to get money into their wallet, right? Every time we solve a problem, we're going to find a new one along the way. And so when you go back and look at big industry transformations, e-commerce adoption, shift in how people invest for retirement, these things are not things that get solved overnight because of technical constraints. It generally takes about 30 years to solve this combination of technical, operational, and human attitude changes. For example, in the 1950s, 97% of like US savings were in bonds and 3% in stocks. By the 90s, it was like 60% in stocks and like 30 to 35% in bonds. So 30 to 40 years for a complete transformation in investing. That's not because you couldn't buy stocks in the 50s. It's because people didn't really understand it. There weren't enough good sort of ideal products like index funds and money market funds and mutual funds. So I think we should expect a similar time frame of adoption and a lot of small obstacles to be solved along the way.
So I guess more specifically, coming back to financial services, how do you see this new set of technologies impacting financial services, right? You gave that example before of a client that launched an asset that nobody seemed interested in buying, but like, obviously financial service isn't known for actually coming up with the innovation itself, more maybe implementing it. Is this going to come from tech and then be adopted into financial services? Where do you see sort of the industry headed?
I see a ton of creativity in the industry, right? And I think people are, in particular at this moment, they're feeling a little bit unleashed and they are casting about for what to do. And they're so, there's like 200,000 different tokens in the Ethereum ecosystem. There are so many experiments going on. I think when we sit back and look at, we tend to pay attention to the stuff that takes hold, but there's a ton of things actually happening, right? So you have, for example, Ethereum staking, right? Ethereum staking is kind of this foundational component of getting some return from Ethereum's transaction ecosystem. But then you have restaking tokens, right? And you have liquid staking tokens. And now people are thinking about sort of risk-free rate of return tools. We have stablecoins. On top of stablecoins, people are thinking about interest-bearing stablecoins, yield-bearing stablecoins, synthetic stablecoins that are pegged to the dollar but contain no actual dollar. So I actually do think there's there's a huge amount of churn going on. Lots and lots of people are coming up with stuff, and we're in this process of trying to figure out what are the product market fits, what's the level of risk people are willing to tolerate. One huge factor, which I think is going to reshape the market in the coming year or two, is lower interest rates. Mm-hmm. So DeFi, decentralized finance, was a hotbed of creativity and cleverness before interest rates went up. But now that you can get 5%, on your bank deposit,
in a bank, right? Plain vanilla.
It's less appealing. Mm-hmm. However, if interest rates go back down to 0.5% or 1%, then the extra 0.5% or 1% or maybe 2% that you can get with some DeFi tool that puts your stuff into a staking protocol or whatever, that certainly goes from being, is it worth the risk, to, wow, I can double my rate of return. I'm much more interested. So I think lower interest rates will supercharge the search for yield, and that will be good for some of the innovation work that people are doing.
Well, so I agree with you that there is an innovation going on. To me, I guess the question is that the top 10 largest banks, how involved are they in the innovation? And what does it take to get them, I guess, more open, I guess, to experimenting there? I'll tell you where I'm coming from. We've had a series of conversations from people, the venture capital level, private equity level, and it seems to be taking quite a long time to get banks, which are typically risk averse, to really kind of open up to this. So I guess my question is, when will we see JP Morgan, do something that's beyond the JPM coin, that's, I guess, more impactful at industry level?
I think we will see that the floodgates break open, so early next year.
And using the word floodgates is pretty amazing to talk about financial services. So I'm going to quote you on that, Paul.
Yeah, no, we had last year when we had our conference, we put this picture of a dam. We said, what's holding all this liquidity back, right? And I believe the floodgates are going to open. And what's going to open the floodgates? There's a bunch of things that have opened the floodgates. First of all, in Europe, this MiCA legislation really made it much clearer about what the rules of the road are. In the U.S., the change in the regulatory environment is going to be absolutely transformational. For quite a few years, but mostly for the last 4 years, we've heard the same story from almost every bank and financial institution we've talked to, which is, hey, we would love to be on public Ethereum. We don't think it will be allowed by the regulators. That period of time is at an end now. Literally, morning after the election, phone starts ringing. People are like, okay, we're ready to start moving again. However, this is an important thing to remember. Knowing what the direction of travel is different than being at the destination. And what I mean by this is we all know what the direction of travel is. We know it's going to full validation of public chains. People will be able to use standardized tokens. A lot of the sort of contraptions people created, like tokenized deposits and stuff that was designed to appeal to regulators, is probably going to fall by the wayside, and people are just going to use standard ERC tokens on public Ethereum because the regulatory environment's changed so much, and it's going to be much more supportive of like a standardized crypto environment. However, regulated entities don't think about, hey, what is my situation going to be for the next 3 or 4 years? They think about, what is my situation going to be for the next decade? And they are not going to do something until new rules are explicitly written. So what we're seeing here is we had a bunch of people on the sidelines. This is an analogy I would give you. We had a bunch of people sitting on the sidelines looking at the race and being like, wow, I'd love to be in the race, but I don't think I can go. Now, all those people who are in the stands are suddenly like, they're pulling off their sweatsuits, they've got their shorts on underneath, and they're headed down to the start line. Right, they're headed down to the starting line. They are not racing yet. And they will not race until somebody who's got a referee jacket on pulls the starting pistol and says, here are the rules, go. Right, and so as I've told my team, like, the private blockchain business model died, right? It died like literally on the 6th of November. But the true race, like, we are in the warm-up. The true race does not start until the rules are laid out and people feel like there is no long-term risk in jumping in.
That makes a lot of sense. Thanks for explaining that, Paul. Given the other hat you wear, the Enterprise Ethereum Alliance president or chairman, what are some of the most interesting things you're seeing there on that side of the house?
So right now, what's amazing about Ethereum is a couple of things. First of all, I just came back from DevCon. So DevCon is kind of the Ethereum big developer conference. The thing that was very encouraging is Ethereum's got a really good roadmap. They've got, like, basically, if you look, for example, at the Beam chain, which is the main sort of the next core transaction processing roadmap, that's a 7-year roadmap. Now, it was so funny. I watched the Beam chain presentation in Bangkok, and I knew on Twitter, like, people were going to dunk on it, like, 7 years to get there, right? And my response is very simple. If you are building and running a multi-trillion-dollar global asset infrastructure, I want a 7-year roadmap. I want a roadmap that calls for multiple months of testing, multiple different standard types of operating clients, client diversity, redundancy. Like, this is what a mature, engineering-driven, risk-averse organization looks like. Blockchains are not designed to be changed overnight. You should not be moving fast and breaking things when you're carrying the global financial system. So the first thing I took away is, like, the roadmap is excellent. It delivers a lot of the scalability and finality things that people want. It is also mature, it's responsible, it's reasonable. That was very positive. Secondly, the level of innovation, the whole locus of innovation in the world of blockchain from an engineering and technology standpoint has shifted from blockchains that tried to compete with Ethereum to blockchains that are inside the Ethereum ecosystem competing with each other. This L2 ecosystem, more than 50 chains, right? AI chains, NFT chains, payment chains, general purpose chains, zero knowledge chains, optimistic chains, right? Sort of hybrid chains. Like, the level of technical innovation going on is incredible. And I hosted the panel at DevCon with no less than 4 different core privacy technologies. And that is super. As somebody who's been building privacy tech for like almost a decade now, to see 4 other really good privacy solutions was both terrifying. Well, let's say 3 others because I was on the panel. Terrifying because that's competition, but also incredibly validating. So the level of innovation that's going on inside the ecosystem is fantastic.
Also, with our last question, I want to look a little bit forward and give you the keys to the castle. I'm giving you, CEO role at one of the top 5 banks in the U.S. If you were to assume that role, what would you do personally, Paul, in preparation for some of the dam opening that you're describing?
So I have several things that I would do immediately. So first of all, think about how people buy stocks and bonds. They don't care. And to be honest, I have no idea. Did you buy my stock on the NASDAQ? Did you buy it on the NYSE? Did you buy it in a dark pool? I honestly don't know, don't care, right? So my first thing would be I'm going to start delivering all of these blockchain assets and solutions and services in a way that's transparent. You want to buy the S&P 500 index, the NASDAQ index, some ETH, some Bitcoin, all in your account, right? That's first thing. I'm going to make it simple and transparent. People are not going to worry where all this stuff comes from. I'm going to do that. Secondly, I'm going to open up a curated window into the world of digital asset tokens and DeFi services. It's the Wild West out there. That's for sure, right? There's a lot of risk. I'm going to curate some of the lower risk, well-executed opportunities, and I'm going to put up that window inside of my ecosystem and give people an opportunity to save and earn money, right, in that ecosystem. And most importantly, I'm just going to make all of these services available to my customers. The nightmare for every bank is that by the time they have all of these services available and lined up, their most valuable high net worth customers have opened up an account at a crypto exchange. So if I were the CEO of a major bank, I would look upon the crypto exchanges as the equivalent of full service competition, and I would start acting accordingly.
Right. That's a really good point as a corollary, because a lot of the crypto exchanges have added on sort of value-added financial services on top of that, and they look a lot like banks today, right?
So there's an old dictum about organizations that oppose each other come to resemble each other, right? And this is what's happening. The banks, the crypto people are invading the banking space. Payments, deposits, interest-bearing yield, assets, treasuries, stocks, right? So the crypto exchanges are offering a lot of banking-like services. The banks need to do the same to hold on to their customer base, and they need to also think strategically, okay, what are the things that I have, right, which is usually a large customer base and a mature understanding
Trust.
of risk and regulatory procedure that I can use to my advantage, right? Because crypto exchanges are usually hyper-growth organizations. They don't have a lot of operational maturity, right? There's a significant opportunities there for the entities that are choosing to act upon their strengths today.
Paul, thanks for joining us on the Tearsheet podcast today. It's been fascinating talking to you.
Thanks for having me.